Can you talk about currency hedging? Yeah. So hedging currencies is kind of like hedging from a stock perspective as well, and it's similar to hedging for commodities as well. So a lot of companies that have a material amount of exposure to a certain commodity like oil, they'll hedge their bets so that they can always buy or hopefully buy oil at a certain price or below a certain price in the long run. So for example, Southwest, ticker LUV, because their headquarters, that's Lovejoy Field in Texas. Southwest is a great American discount carrier, and I'll get to currency in a second. But what they did was, in the early 2000s, they realized that their biggest expense is oil, and they were worried that the price of oil might go up. And so what they did was they hedged their oil exposure for at least a decade at like $30 a barrel. And then oil went up to $150 a barrel in mid 2008. It did. And what happened was Southwest realized that their competition was in a lot of trouble. And so they did something predatory. They actually cut prices on their tickets. And they're very profitable because they hedged their oil exposure. Moving on to currency. Best example I can give is SAP. It's a great German software company headquartered in Waldorf, which is about 2 hours away from Frankfurt. And SAP has a lot of exposure to the United States, revenue-wise. And so what happens is if SAP makes a lot of money one quarter in the United States, it helps their business a lot, especially if the euro is falling and the dollar is rising. Because when they repatriate or move the profits back to Europe or back to Germany, where they're headquartered, they make a lot more money. However, sometimes they're worried about this type of exposure. So what they do is they hedge their US dollar exposure. And what you can do is, and they usually have pretty sophisticated investment banks and prime brokerage firms and trading floors take care of what I'm about to tell you to do. But what they do is they set up what's called a straddle. And what that means is if the US dollar goes up a lot or down a lot, it's not going to matter. Okay, so they're protected if it goes up and if it goes down a bunch. And a lot of people use straddles as well when it comes to investing if they have a big position in a company. And let's say that somebody owns a lot of shares in one stock and they don't want to sell their entire stake before earnings are released. But they realize that the stock might go up or down a lot. And so what they can do is they can set up a straddle, which basically means they're hedged. So if the stock goes up a lot, they don't make money. If the stock goes down a lot, they don't lose money for a certain period of time.